Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Taking shape, debt talks in D.C. inch towards an agreement, which is said to include lifting the cap for 2 years. Missed the boat. Cathie Wood's flagship ARK fund dumped Nvidia stock right before the chipmaker's blistering $560 billion rally. Plus, tech stocks propel Europe and Asia markets higher, even as U.S. futures stall before key U.S. inflation data. Two-year Treasury yield snapped 10 days of gains. Well, fitting that it's Friday and we're getting a pause, a breath, a consolidation of some of the major trends we've seen this week. We are looking at some gains on European indexes. If you look at where this is coming from, it's from a lot of places that have been beaten up over the week, so a little bit of nibbling around the edges there. NASDAQ futures, those come in. Of course, it was such a strong rally yesterday, all off the back of Nvidia. NASDAQ itself rallying about 2.5% yesterday. Nvidia adding $180 billion worth of market value. Really one of the top biggest movers in history. Apple and Amazon, I think, each had a day that was better in terms of adding market cap, but it is still up there. Two-year yields, again, these come in. It had been a day of selling off bonds yesterday, the front end getting clobbered. We had some jobless figures that showed that this is still a hot market. There was a lot of revisions to past data, too, which suggested the trend actually isn't as improving as we thought it was. Finally, euro dollar, again, this is a bit of a change. The dollar, it had been strengthening to a point where we saw the yen hit 140 per dollar. But again, that's coming in a bit this morning. Now, looking at the overall Europe, Matt, again, I mentioned that for Europe, it's a lot of reversals of some trends. The CAC 40, for example, that's basically unchanged this morning. It has fallen about 3.5% this week, so we're taking a pause there. A lot of metal and mining companies doing well. Commodities having a pretty strong day, again, after a weak. So we're looking at FTSE 100. That's doing better. Of course, a lot of those companies living in that index. All right, let's talk about the debt ceiling, because it's really been our top story all week. White House and Republican Party negotiators are said to be moving closer to an agreement to raise the debt limit and cap federal spending for 2 years. Meanwhile, the amount of money the government has to pay its bills tumbled to the lowest since 2021. For more, let's bring in Bloomberg's Jill Desis. Jill, how close are we to getting a deal at this point? Are we any closer than we were 24 hours ago?
Well, Danny, it actually does seem like maybe we're moving a little bit closer. So what we've heard is that, as you mentioned, this plan seems to be in the works. Potentially, we've got an agreement to cap federal spending for 2 years. And of course, this is a far cry from what Republicans originally wanted, which was a 10-year spending cap. We've heard that the amount under the cap has not yet been finalized. There's some discussion about maybe allowing defense spending to increase next year. Maybe there's some conversations happening about upgrading the electric grid for renewable purposes. Maybe there's some speeding up some pipeline permits, which is something that Republicans would want. There's still a lot that needs to kind of be hashed out here. But ultimately, what this means is that there could be something that the White House negotiators and then these Republican negotiators put together by Friday in the U.S., so today. And then because there's an extended holiday weekend for Memorial Day, ultimately what that means is that there could be something that's presented to Congress to vote on by Tuesday. So we're really running up pretty hard against that deadline there, that X-Day deadline of June 1st. But ultimately, yes, it does seem like maybe something could go forward.
So if we were to get something like spending caps, what would the implication of that be on the broader U.S. economy?
Well, I think what we need to do is we need to see the devil's in the details, right? So we need to see exactly how all of this progresses with what those spending caps look like. Is that going to be finalized? Is that something that Congress is going to, be voting on? What economists have said in the past is that spending caps have the potential to tip the economy into recession, or I guess at this point, if the economy is already in recession, deepen issues there. I do think it has some implications for the Federal Reserve's interest rate hike cycle, but we'll have to see what those details look like once we get those a little bit, hopefully later Friday or, potentially into next week. So I think still a lot more to come as we get more details, but it does seem like today, at least, is more optimism, or at least more signaling that we're moving closer to something that we've had really all week.
Yeah, and of course, we had that warning from Moody's that there's that June 15th interest rate payment. If they don't get there, that might be the source of a downgrade. Jill, thank you so much for your coverage as Bloomberg's Jill Desis. Now, short-dated Treasury yields surged yesterday. I mentioned this after U.S. jobless claims came in lower than expected. GDP at the same time was revised higher. But the 10-day rally in the two-year yield has been taking a bit of a breather this morning. But that is off the back of the longest streak of advances in 5 years. Traders are now pricing in a greater chance of further interest rate hikes by the Fed. Let's speak about this to Frederique, head of investment strategy at RBC Wealth Management. Frederique, so we're taking a pause today, but the trend is in for the week. Higher two-year yields, a flatter curve. Do you want to follow that, or do you want to fight against the trend?
Look, we don't think that the best investment opportunities are in the US at the moment. We think that US rates are fairly valued. We think that US equities are priced for perfection, for avoiding a recession, inflation coming down. For us, there are better opportunities in the UK markets, particularly with respect to fixed income. We think that the market is much too aggressive in terms of its expectations of UK interest rates. We don't see the Bank of England being able to move as far as the Fed in terms of interest rates because of a much more powerful monetary policy transmission mechanism in this country than in the US. So from a fundamental point of view, we think that UK rates are interesting. And of course, they've been very, very oversold. So this is where we would seek opportunities.
Oversold, I mean, especially in the past 2 days, if you're talking about the movement. I mean, we are 6 basis points, somewhere around there, from that top we saw after the Liz Truss mini budget. And Frederique, you talk about this idea of the transmission mechanism, of the transmission of tighter policy to people in the UK. Why then haven't we seen inflation come in? Why are we still looking at persistent prices in this country?
There's always a lag between the tightening of monetary policy and what we are experiencing on land. So we would expect this to start showing up later in the year, for inflation to start falling more visibly later in the year. However, yeah, it does take time. There is a lag.
I mean, how do we actually judge that? Because it's not like the rate hikes are new. It's been happening, and it's been happening quickly. I mean, how do you actually assess? Because we hear it all the time, long and variable lags. But what does that actually mean? What are we waiting for? What needs to happen to see some of the effects of tightening policy show up?
So we probably need to see some mortgage renewals taking place, and there's a very high percentage of mortgages which will be renewed later in the year that will put further pressure on household budgets. But remember, what has driven inflation has been energy prices. Monetary policy can't do very much on that. And now it's really food prices. Again, monetary policy is quite powerless. So what the Bank of England is trying to do is try to ensure that inflation expectations are not anchored at too high a level, and try to impact wage gains, trying to ensure that they are not running too far ahead of inflation. And of course, at the moment, wage gains are quite strong. It's wage gains, it's corporate pricing power, which are really ensuring that inflation is remaining at much too high levels.
So if you think UK gilts, if they're attractive right now, where on this curve are you buying?
So given that we think we are probably closer to the end of the tightening cycle, we prefer the long end towards rather than the shorter end.
Okay, Frederique, really great to have you on this morning. We appreciate your time. Frederique Carrier, the head of investment strategy at RBC Wealth Management. Coming up on the program, missing the boat. Cathie Wood's ARK dumps Nvidia stock before a $560 billion surge. We're going to discuss that and more on the AI boom next. This is Bloomberg.
We definitely are feeling a lot better than about 6 months ago. I recall probably talking about Nvidia going up to $1 trillion company when it actually dropped at about 300 billion in October last year. But if we look at the fundamentals of the company and our forecast remains still significantly ahead of the consensus. So we are definitely not selling, but at the moment it's already the largest position in the fund and we cannot go more than 10% in the fund. So it's very close to that not line, but we think there's still further upside to go from here.
Blue Whale Capital CIO Stephen Yu speaking to me earlier on the surge of Nvidia, his fund's largest holding. But a rising tide doesn't lift all boats. ARK, of course, Cathie Wood's flagship exchange-traded fund, closed out its Nvidia stake in early January, right before the AI frenzy that sent the stock and its big tech peers on a tear. Now, in February, when Nvidia traded at $234 a share, roughly 50 times forward earnings, Wood said that the valuation was, quote, very high. Now, she still does have a stake, it's a small one, in the chip maker through 4 smaller funds. For more, let's get to Bloomberg's Alex Webb. So, okay, she does still have some of this, but she seems to have largely missed out on the rally so far year to date for Nvidia. Why would her approach be different in that she would ditch it right before we saw this big upswell?
It was interesting because, actually, Nvidia sort of looks like a bit of an outlier in terms of the companies that she tends to invest in. It is, fundamentally deep tech. She doesn't have many of those. A lot of the things that she does are kind of more consumer-facing. There are, of course, some things in genomics and biotech where she has some investments, which isn't obviously consumer-facing, but they often kind of make products. Nvidia is really about in the component space, and perhaps it was almost a surprise she had it, given the nature of other investments, which are like Tesla, Roblox, things like that. So I don't think she missed it completely. She, as you say, I think she has about $150 million stake in Nvidia as things stand, and she rode a little bit of the prior wave, but she has, it seems, missed out on the massive money.
Well, if you want to buy based on valuations, Alex, we've been talking about this, and I find this really fascinating because you could say, okay, look at this huge rally. But I know you've got a deeper dive into just some of the ratios here. I mean, valuations have come down.
So in a sense, Nvidia's become cheaper,
yeah.
Right? It was actually trading at around 60 times its forward earnings prior to this announcement. As it increased its forecast, what we've seen then is analysts also increase their estimates. Consensus has therefore gone higher, which means the price to earnings ratio, and you can see it in this chart right at the very end there, falling off a cliff. That is the drop in the PE ratio. So it has come down to that 50 times forward earnings, 49 times I think it is, which, of course, a few months ago, Cathie Wood was saying looks expensive. But if you look on a slightly longer time frame, 2 years, 3 years, it comes down to below 40, and that isn't actually massively out of kilter with other parts of the S&P 500. So, look, I'm not a stock picker. It doesn't look, though, as crazy as at a first glance might have you believe.
I think you're literally prevented from being a stock picker by being a Bloomberg News employee, so I hope you're not, Alex. Look, that chart also says to me just this big readjustment in forecasts and forecasted earnings is that a lot of people were just caught off guard by how strong their earnings were. Why, though? Why was this such a shocker? I mean, a good shocker, but such a shocker coming from Nvidia?
Well, people didn't quite know how real this thing was, right? We've had lots of false dawns in technology over the past however many years. Web3 was supposed to be a huge thing. It's sort of fizzled, and we haven't, I'm not going to say it's died, but we aren't really seeing much meat on the bones yet. AI looks like a real technology, and crucially, look at the people who are driving it. It's Google, it's Microsoft. These are companies who are selling it essentially as a cloud product. If it's going to be a cloud product, they need to have the infrastructure to support it. That's why they're turning to Nvidia. I think there was also some questions about whether there was enough capacity out there. It is very clear now that there is, right? There's the capacity to make these chips, largely because a lot of the new investment in semiconductor capacity is at that bleeding edge, sub sort of 7 nanometer. That is the stuff that is feeding this rally from Nvidia.
Yeah, and it was the supply chain pains, which I guess have kind of eased off as well. A story from COVID really through the past couple of years. Alex, thank you so much for joining. That's Bloomberg's Alex Webb there on Nvidia. Now coming up, Turkey heads back to the polls this weekend as the president faces his first ever runoff election. We're going to have more on what's at stake next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your first word news. With that is Alex Morgan. Alex.
Danny, good morning. Bloomberg has learned that UBS and the Swiss government haven't agreed the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources tell us the deal's completion could be pushed back to June instead of late May. Well, UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. The Bank of Japan's Governor Kazuo Ueda says the BOJ's balance sheet isn't necessarily in a normal state, given the bank's large holdings of government bonds and ETFs. Ueda has also played down the importance of wages or any single economic data set as a trigger for change. This suggests his desire to hold on to policy flexibility, leaving speculators guessing about the timing of a policy shift.
On how wages might lead to policy change, we aren't targeting wage growth itself. If we have sustainable and stable inflation of 2%, it's natural that wages should also rise. The key point for our policy decision is whether inflation will rise in a stable and sustainable manner at 2%.
Going green, Siemens Energy says it's experiencing a surge in demand for green transition technologies as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, the CFO, Maria Ferraro, says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Well, that is global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you very much. Now let's talk about Turkey, and its central bank has extended its interest rate pause for a third month as it tries to keep the lira stable. The policy decision comes just ahead of the country's presidential runoff this weekend. Bloomberg Daybreak Middle East anchor Yusuf Gamal Al-Din joins us now on this. So, Yusuf, this interest rate decision, why is it so important heading in to the election?
Well, Danny, I mean, you already laid the groundwork there, but it's all about a repo rate that stays at 8.5%. No change as we count down to the runoff for the presidency on Sunday. The reality is that you've got inflation at 44%, and the central bank's already been intervening in the Turkish lira trade to try and offset some of the weakness. They did not want to be seen taking sides. And the bigger question is, who's going to come out on top on Sunday? Remember, round one, the incumbent president, Recep Tayyip Erdogan, he got 49.5% of the vote. Kemal Kılıçdaroğlu, his most credible threat, came in second. And Sinan Oğan, who was the third contender, he is now backing the incumbent Recep Tayyip Erdogan. As much as the president has made a name for himself with unorthodox monetary policies, the vast names that we've spoken to in the run-up to round one and a little bit after as well in the last few days suggest that they're not sustainable, these low policies. You cannot keep interest rates low at a time of high inflation, Danny.
At the same time, Yusuf, Turkey's net reserves have fallen below zero. What's at stake there?
Well, I mean, look, I've not encountered a negative net international reserves position before in any of our coverage, and we had to go back 21 years to see precedent in Turkey. And you reach a net international reserves position when you're struggling to attract foreign currency. In this particular case, it is when you've got reserves that are lower than your liabilities. At the same time, the local currency is not the best indicator of investor sentiment. If you're looking to see how investors are positioning, you look at the credit default swaps, you look at bonds in Turkey, and you look at the stock market, which was for local investors an important hedge for the high inflation rates. That's no longer the case. Stock on an index level have come down, so we're lower by about 18.5%. It gives you a sense of the kind of stakes that are at play. As we count down to Sunday and probably going into very early Monday, we should have a clear picture about whether President Recep Tayyip Erdogan is going to get another term or Kemal Kılıçdaroğlu is going to take over.
Okay. Yusuf, thank you very much for that. Looking forward to your coverage of the runoff. That's Bloomberg's Yusuf Gamal Al-Din. Now, today has been a lot of pulling back from some of this week's trends. We are looking at UK two-year gilt yields that have come in a bit, but look at this one-year chart. So if you see that spike up in September, that was the mini budget from Liz Truss when we saw pensions having to unwind due to margin calls and the BOE needing to step in. Today, we are alarmingly close to that level. It's a run-up over the past 2 days. Again, it's coming in today, but a run-up of more than 30 basis points, which got us there. I was talking to Athea Spinoza of Saxo Bank earlier, who said she is worried. There's less stress in the system. We're more prepared for it this time, but that doesn't mean we're in the all clear. The BOE might need to act more aggressively. Coming up, we're going to talk about the debt limit negotiations in Washington. This is Bloomberg. Taking shape, debt talks in D.C. inch towards an agreement, which is said to include lifting the cap for 2 years. Missed the boat. Cathie Wood's flagship ARK fund dumped Nvidia stock right before the chipmaker's blistering $560 billion rally. Plus, tech stocks push European and Asia markets higher, even as U.S. futures stall before key U.S. inflation data today. Two-year Treasury yields snap 10 days of gains. Good morning. Happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the amount of money the U.S. government has to pay its bills has fallen to the lowest level since 2021. With less than $50 billion remaining, the Treasury could run out of funds as early as next month if a deal isn't agreed to raise the debt limit before then. Let's get more on this with Bloomberg Markets reporter Justina Lee. Less than $50 billion. What does that say about when we might run out of money at this point?
I know. Treasury Secretary Janet Yellen keeps saying, the deadline is the start of June. There's still a bit of debate about that. But what's interesting is that a lot of sell-side strategists have kind of moved forward their prediction of this X date to kind of align with the administration's prediction, so around, the start of June, even though there are some people that still think that maybe the U.S. government will have some leeway through summer. But there's definitely a sense that anxiety is rising.
It's kind of hard to figure out how the market is taking this because you have to also deal with the Fed, you have to deal with Nvidia. Where are you looking at to try to get a sense of how the market's handling all this?
I think the most obvious sign is what's happening with the Treasury bill curve, where you very obviously have this spike in the yield premium around the date of, the X date, which is around June 1st. And what we're seeing here is that yield kind of popped above 7%, but it's receded a little bit in the last few days with some optimism over an agreement. And I think another place where that's very obvious is the credit default swap market, where the U.S. is now demanding a premium that's actually even higher than a lot of EM countries. But I think you're right. Apart from that, stock market seems, pretty sanguine overall. The Treasury market, obviously, there's also the Fed factor coming in. And so I think in the stock market, maybe it's not as obvious just yet. But I think you can see today, for instance, that European stocks are rising and maybe some optimism over the talks are feeding into that.
Right, because on the Fed front, we're all looking at the weekly jobless claims. But is there a world where this does change the debt ceiling? It does change folks' expectations for what the Fed does?
I think for sure. I think what's happening right now is that people are not yet that pessimistic about an actual, default. And because of that, people have focused on still resilient U.S. data, as well as, those stickily high inflation numbers. And that's actually why markets have actually started pricing in, increasingly a rate hike coming in, next month or the month after that. And we've seen Treasury yields react to that. But if there is a default, then I think immediately people are thinking recession. That obviously changes the picture.
Oh, yeah. Let's hope we don't get there, because we will be very busy that day if it does happen. Justina, thanks so much for joining. That's Bloomberg Markets reporter Justina Lee. Now, Nobel Prize-winning economist Paul Krugman has downplayed the concerns about the U.S. government's burgeoning debt ahead of a potential default next week. But he told Bloomberg's David Weston current economic policies risk undermining America's future prosperity.
The thing that concerns me most, partly we're just talking about the functioning of the government, right? We're talking about being able to get some money on the line. With the Social Security administrative costs, the IRS. It's not just that we're giving the IRS resources now that will help it crack down on tax evaders, and that's one of the things Republicans want to cut. The other thing is, if you have a question or a problem with your taxes, it's gotten suddenly a lot easier to get hold of somebody at the IRS, which was, still is to some extent, in desperate straits. But what really bothers me, where we are right now, is that the programs that apparently are sacrosanct are programs for the elderly. Medicare, Social Security are off the table. They're being protected. And a lot of the stuff that's discretionary is really things like programs that support children, that support education, that support nutrition for the young, which is the future. So what's happening right now is that in the effort to hold down headline spending right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
So that is a terribly important and very unpopular point, going back to the politics for a moment here, and that is when you say, let's cut things for the elderly. That's not very popular. I'm elderly at this point. But at the same time, we're not really investing in future growth, as I understand it, by paying more, for example, on Social Security, whereas investing in education or children or infrastructure could increase the future growth. To what extent do we need to be concerned about growing ourselves out of whatever debt issues we have?
Well, to a large extent, that's going to happen anyway. I mean, when I say you need to adjust for inflation, you really also need to ask about growth. And, the example I always like to use is, how did we pay off the debt from World War II? And the answer is we didn't. We had slightly higher debt when John F. Kennedy took office than we did on, when we declared victory over Japan. But the debt had dwindled. It was less than half the share of GDP that it had been at the end of World War II, because we had a growing economy and a little bit of inflation over that period. And that's largely, we're still in a world where we really are already set to, if not exactly grow out of our debt, at least not have it grow very much, uncontrollably, unless we do, some really even more irresponsible things than we do now.
Nobel Prize-winning economist Paul Krugman speaking to the anchor of Bloomberg Wall Street Week, David Weston. Coming up, one of the City of London's most senior black professionals says more radical change is needed in the Square Mile. We're going to discuss that next. This is Bloomberg. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. London's financial services industry needs more radical change on racial equity. That's the call from one of the city's most senior black leaders. The remarks from Richard Iferenta come as black workers say the momentum for change has stalled in recent years. Olivia Kanotea-Hulu, our equality reporter, joins us for more. Olivia, how optimistic are black professionals about change in the city?
I think there's really a range. So on the one hand, people are happy that George Floyd and the Black Lives Matter movement really put, those tragic events put these issues on the agenda in a way that they weren't before 2020. But there is a sense that there was such kind of intense commitment and pledges and feeling towards it in 2020, and that has now faded, and now that momentum has been slowing down.
This is such a simple question, but probably the most complicated of answers. What are the solutions?
Well, I think, there's a range of things that can be done. But I think one really interesting point people talk about is culture. So there's a lot of efforts to bring people in and on recruitment. Then there's a sense of how long are people going to stay for? How good is retention going to be? Because if you don't change company culture to make sure that people have opportunities and thrive within companies, then what's the incentive for them to stay?
So what are some of the key barriers? I mean, you mentioned culture, which is obviously a huge one, but what are other ones that people are seeing?
I think the issue at the moment is that the macroeconomic environment has been really challenging. So that means that some of these measures have kind of been, I think, deprioritized a little bit, is the sense that I've been getting. So I think it's just the issue that with things like the war in Ukraine and the cost of living crisis, it's just that it's less kind of high up on the agenda. And I think that's kind of some of the challenges as that trickles down from the top potentially to the lower level.
And was that the same with COVID? I mean, is this just keeps coming up as an excuse?
Well, it's interesting because the Black Lives Matter movement and George Floyd's death happened in COVID.
Yes.
Some people say that kind of really intensified the whole thing. But the issue at the moment now is that because about 3 years have passed now, it's almost 3 years to the day since George Floyd was killed, that people are starting to say, what about other demographics? What about other groups? Should we just be focusing that much on black people? But as one person said, you know, the evidence isn't showing that the disparities are closing when it comes to black people specifically. So, you know, it's still worth addressing.
Absolutely. Olivia, fantastic reporting. Really appreciate you joining us today. That's Olivia Kano-Teahulu, our equality reporter. Now, we're going to be covering all things all UK every week. That's on Thursdays at 9:30 a.m. London time in our half-hour special. So be sure to tune in for that. Now let's get to your Bloomberg Business Flash with some of those top corporate stories. Is Alex Morgan. Good morning, Alex.
Good morning, Danny. Bloomberg has learned that UBS and Credit Suisse are offering a rare incentive for their wealth bankers in Asia. Relationship managers will receive a commission of 15 cents for each $100 of new client money they bring in. The move comes as these Swiss banks look to ensure stability as they seek to complete their merger. Alibaba says it plans to hire 15,000 people this year, pushing back on reports that the firm is laying off employees. The Chinese e-commerce giant described reports of layoffs as rumours and said employee departures are part of the normal flow of the business. And Bloomberg has learned that the TSMC is in talks to receive German government subsidies for up to 50% of the costs of a new factory. Our sources say the negotiations involve a plant in Dresden to be built at an estimated cost of close to $11 billion. The top end of the subsidies being discussed are similar to what Japan has offered TSMC. That is Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you very much. Coming up, it keeps getting worse for Carl Icahn. Another 25% drop in Icahn Enterprises shares is raising questions, including the big one: how is the billionaire going to get out of this? We'll be discussing with our hedge fund reporter next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Human Capital Management founder and CIO Kyle Bass, who has been predicting serious pain in the U.S. office market, is taking a different view towards data centers. His remarks come after chip maker Nvidia surprised analysts with a bumper revenue forecast, propelling a surge in AI-related stocks.
The one thing that I see from the macro perspective is everyone thinks commercial real estate, is in the tank, and it's really just focused in the office market. When you look at the data center market, it is white hot. People that are developing data centers don't even get them developed before one of the FANGs leases it for 30 years. So I have a friend that has 13 data centers that they were developing all over the country, and in one phone call, did a $3 billion multi-decade deal with one of the FANGs. They just leased the whole portfolio. So data centers are white hot. Nvidia is white hot, and as you know, we're building the TSMC's building both a 5 nanometer wafer fab and a 3 nanometer fab in Phoenix. We've got Samsung building in Texas. We've got Intel building in Texas. The U.S. is reshoring, onshoring this high-powered chip business, and Nvidia is leading the way. First with their GPUs and their gaming chips, and now their generative AI stuff that is just again white hot. I wouldn't short Nvidia. I think it just has a long way to run here.
When you talk about a long way to run, how should we be thinking about this? Is this a generational shift that we're experiencing here, Kyle? In 2000, we had to have a massive clear out before we figured out who was going to actually be top dog on the internet. Turned out to be Amazon and companies like that. Are we going to have to see something similar here? We're going to get a lot of people coming at this from different angles. How do we clear out and figure out who's going to be the winner, who's going to be the loser?
Yeah, again, I look at this from a different perspective, especially on the losing side. I keep reading everything from Wall Street telling me that AI and generative AI is going to be jobs positive. Mm-hmm. I just have an impossible time believing that. We've got 3 million plus, let's say, service workers that run cash registers or front ends of businesses in the U.S. We've got 3.5 million truck drivers. I I can look through the businesses that I'm fairly certain we're going to see millions of job losses in. And I don't think you can train those specific people or retrain them into, let's say, the high tech market. So I'm worried about the long-term job possibilities. I mean, just think about how many pilots are out there, and really, how many pilots are we going to need when we get real? Let's just say, what right now the big planes essentially fly themselves. So we don't need the big crews that we've got. Anyway, I think about how many jobs are going to be put out of business as this
So Kyle, so to that point, so you're thinking, okay, AI is this huge trend. It is a structural shift. It's going to have big implications for the job market, the economy, and productivity. Do you play that? Do you trade it? Is this like you mentioned, you go buy data centers? Like, how do you capitalize on this sort of evolving trend?
Yeah, I mean, developing data centers, owning public data center stocks, securities. I mean, that has given ChatGPT and the amount of compute that's taking on the back end. I hear that Microsoft and Amazon and the rest of the cloud providers are struggling desperately to keep up with the amount of compute that's going on with ChatGPT. And again, that's only going to grow exponentially as AI gets stronger.
That was Heyman Capital Management founder and CIO Kyle Bass speaking to Alex Steele and Guy Johnson. Let's get you your first word news now. With that is Alex Morgan. Alex.
Good morning, Danny. Well, we start in Turkey, where the central bank has kept its benchmark rate on hold at 8.5% for a third month in a bid to stabilise the lira. The policy decision comes ahead of Sunday's election runoff. President Erdogan is looking to extend his 2 decades rule after leading the first round of voting but failing to take 50% earlier this month. Bloomberg has learned that UBS and the Swiss government haven't agreed the precise terms of the state guarantees for the emergency takeover of Credit Suisse. Sources tell us the deal's completion could be pushed back to June instead of late May. While UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. And Siemens Energy says it's experiencing a surge in demand for green transition technologies. That's as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, CFO Maria Ferraro says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Well, that's global news on your Friday morning, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Danny.
Alex, thank you very much. It keeps getting worse for Carl Icahn. Shares in Icahn Enterprises plummeted as much as 25% yesterday, closing at the lowest level since 2009. The billionaire's personal fortune is also dwindling. That slump alone has cost him $979 million. It's just one more bad day in a weeks-long run of them for the legendary lone wolf of Wall Street since short seller Hindenburg Research trained its sights on him. The questions keep coming, including the big one: how is he going to get out of this? So let's ask that big question to our hedge fund reporter, Nishant Kumar. Nish, how is he going to get out of this?
Well, first of all, let's not forget that he's still very, very rich. Despite some 16 billion blown away, his net worth is still more than 8 billion. The problem for him is that he has borrowed billions of dollars against his stock in the company, which could lead to margin calls if the stock keeps falling like this. We should not be giving investment advice to a billionaire, but one of the options he has that he can buy back the shares, he can go private. Remember, he still owns, and he owns 84% of the company, and the stock has crashed by 60%.
It's probably worth doing a little bit of hedgy history here. Bill Ackman was tweeting quite a bit. Excited by this whole event? Why, Nishan? What is it about these two?
Well, indeed, there is no dearth of friendship between the two famed activist investors. Let me remind our viewers here that Ackman famously fought with Icahn a decade ago over Herbalife and ended up losing a fortune. Now he keeps roasting Icahn on social media. He has even said that the company reminded him of Archegos, the family office of Bill Hong, which was blown away, collapsed last 2021 because of his leveraged bets.
Yeah, amusing to see that play out on Twitter. Nishan, there's a little bit of irony here, because here you have a famed activist investor who usually goes into companies and tries to change something. And we have that type of targeting investor becoming a target himself. Has that happened before? How rare is this kind of thing?
I mean, so there are not too many activist investors listed, but we have seen increasingly Third Point, Bill Ackman's own firm has a listed vehicle as well. So this is not for the first time. Again, let me remind our viewers that in 2021, one of the biggest shareholders in a London-listed fund managed by Dan Loeb, Third Point, launched a public campaign demanding changes there. And just last year, a London-listed money pool linked to activist firm Trine said that it will return clients' capital and close after months of wrangling with their investors on how the fund is run. So it's not the first time at all.
When it comes to the Hindenburg accusations, what are they actually, Nishan? We've got about a minute here.
Yeah, I mean, it's a list of acquisitions, but Anderson, who recently very famously took on India's Adani Group, has accused the company of costly missteps, lousy performance, and above all, dramatically high overvaluations. So basically, he's saying that the company is traded at a higher price than the value of the underlying assets, which is not normal in this year. Normally, closed-end listed funds trade at a discount because you can't exit them quickly.
Okay.
Of course, Icahn has called this allegation self-serving and vowed to fight back.
Yes, absolutely. Hey, Nishan, thank you so much for that. That is Bloomberg's Nishant Kumar. Bloomberg Surveillance Early Edition. It continues in the next hour. Kriti Gupta is in New York. Tom McKenzie here in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Hurdling ahead, Republican and White House negotiators are making progress towards a debt ceiling deal, which is said to include capping federal spending for 2 years. Tech shares remain in focus amid the frenzy for AI stocks, but investor Cathie Wood is missing out. Her flagship ARK fund dumped its stake in Nvidia right before the chipmaker's blistering $560 billion surge this year. And Ford strikes deal with Tesla in a rare partnership among rivals, giving its customers access to the largest, fastest and most reliable network of EV chargers. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, stepping in, of course, for Anna Edwards temporarily here in London with Kriti Gupta in New York. Kriti, there's a little bit of optimism across European equities this morning, but once again, investors here held hostage by the news coming out of DC.
Absolutely, and that becomes kind of where the focus starts to shift a little bit on some of the fundamental stories. And note, I said just a little bit. You are seeing futures virtually unchanged here, Tom. Essentially this idea that as Washington puts you in a stalemate, do you buy in to the hype that you are seeing in the tech space, not just the AI-driven rally in Nvidia and some of its peers? We're going to dive into that in the rest of the show, but some fundamental stories as well. The Tesla story that you just talked about, the idea that the world is changing, tech is becoming a bigger part of our lives, but is that enough to really incentivize stock market investors? At least in this morning's trade, it doesn't quite look like it. Futures really set unchanged, 41.56 on those contracts. The two-year yield, though, continues to surprise to the upside, 450, almost 450 on the front end of the curve, getting very scary scarily close to the 5%. I love to round up, kind of like when you're young, you round up to the age that you really want to be at. 2-year yield at 4.49, coming down a little bit in this session. So really watch the technicals here, because again, as you say, Tom, the debt ceiling debate is really what's going to be driving the bond market, at least as we get closer and closer to the X-date. The last Friday before we head off into the long weekend stateside, and Congress apparently does not work the long weekend. So something to keep an eye on. The Bloomberg Dollar Index down about 0.2% following the yields picture, but inverse, you get the commodity picture a little bit higher. That kind of dollar weakness perhaps giving a little bit of a tailwind to NYMEX crude trading, Tom, with a 72 handle.
Yeah, it's interesting. Commodities, we're seeing a big tick up in terms of iron ore prices and copper prices, so reversing a bit of a trend that we've seen this week, and that's lifting the sector, basic resources across Europe this week, or at least in the session today, I should say, and the FTSE 100 benefiting to some extent from that. You're flat, though, now across the FTSE 100. Across the European benchmark, very, very modest gains. Again, part of it is down to investors waiting to see what happens in terms of that debt ceiling debate. And, of course, in the UK, the focus is on what's happening with yields, because they continue to run up. And the focus as markets start to price in maybe 5.5% in terms of the Bank of England, with the Fed, of course, in focus as well, repricing, and the PCE deflator indicator out later today. Across some of the individual names, we can change on the board then and see how things are shaping up. There's a couple of individual corporate stories that are of interest in terms of what's playing out here. Rio Tinto, again, talking about the basic resources story. Rio Tinto being revised higher by analysts in terms of their price targets for this stock. Morgan Stanley pushing up their rating on the company because they say that its copper holdings are underappreciated. And that ties into that EV story that we were talking about. Tesla, Ford, EVs, of course, copper central to that. And Morgan Stanley saying that's underappreciated as a stock, and it's rallying today in the session. A very different story, though, for Casino, which is a major owner of supermarkets in France. If you ever visited that country, it may have been a place you popped in for a box of croissants and some foie gras. It's currently down about 8.4% because they're in negotiations with some of their creditors. The stock was suspended on Monday, retrading again today, and pressure on that stock as they look to sell off some of those supermarkets. Again, across the benchmark, modest gains of 0.2% here in Europe. Kriti.
And of course, to your point, Tom, even as we watch those micro stories, the macro still surrounding the Washington debate around the debt ceiling. Republican and White House negotiators are moving closer to an agreement to raise the debt limit as they try to avert a U.S. default. Nobel Prize-winning economist Paul Krugman spoke about his concerns yesterday.
What's happening right now is that in the effort to hold down headline spending right now, we're actually kind of disinvesting in the country's future, and that's pretty alarming.
Joining us now is Bloomberg economy and government editor Jill Deese. Says, Jill, it looks like we're getting closer to a deal. It's starting to see some of the cracks kind of getting closed, but what kind of progress have we made? Are we going to make the X-date?
Well, Kriti, it seems like we might actually make it. I think that what we're seeing is potentially a deal that's put together by the Republican negotiators and White House negotiators as early as today, Friday, in Washington. Now, while they haven't agreed on the amount that they'd be putting under this cap, it does seem like they're moving toward agreeing to plan to raise the debt limit and cap federal spending for 2 years. There's some provisions that are still being discussed in terms of energy grids. We've got some fossil fuels discussion in there. So all of the details behind that, including, as I said, the amount still has to be worked out. But ultimately, it does seem like there could be something that goes to Congress as soon as Tuesday. And then that would set us up, if that is able to get through, for something that puts us in deal. It gives us a deal before we actually reach that X-date.
I wonder, Jill, if not in the US then elsewhere, whether the spending caps that are going to come through as a result of these negotiations are being overlooked, at least underpriced by markets.
Yeah, Tom, so I think that ultimately we need to see what the details actually are for these spending caps. And I think that that's probably what markets are looking for, right, is there's more details. I mean, we're sort of in this weird flux zone right now where while it's somewhat optimistic that we do have some progress here, at least compared to where we were earlier this week. We at least have an idea of how long the spending cap may be. Remember, again, Republicans were originally looking for something as long as 10 years. We still don't know that total amount yet. We still have to see how all of this breakdown looks like. So hopefully we'll have something that gives us a little bit more insight into that by the end of Friday. And then maybe that's something that investors can actually look at as they're trying to price in how exactly this could have, bigger impacts on the economy going forward.
Jill Deesis covering all things of the debt ceiling for us. We thank you, as always, of course, watching that very, very closely. But at the same time, we're watching the consumer, the underlying U.S. economy, with warning signs already flashing on the health of that spender. Quarterly earnings from big box and budget retailers this week gave us insight into the depth and duration of the economic slowdown. Just a couple of names, Costco and Gap, rounding out the earnings season at yesterday's close. Joining us now to walk us through it, Bloomberg's Simone Foxman. Simone, a mixed picture from Gap and from Costco.
Yeah, Costco came in pretty weak, but a lot of the drag on the earnings per share, about 50 cents drag, was based on its ending its container shipping business. So that, I think investors reacted to that, and then they looked through the earnings and were a little bit more optimistic. But overall, Costco reiterating some of what we heard from the other big box retailers. People are spending less when they are coming into stores, and Costco specifically focuses on a pretty high-end segment. So that was sort of an interesting data point. Also, an interesting data point out from Gap. Shares did pretty well after the company beat a lot of estimates, but there was a very low bar among analysts. This is a company going through a turnaround story, and we've seen a really mixed bag in apparel over the past couple of days. Again, companies beating really low bars that executives set, but also this idea that there's not a recession yet, so people still are spending on some of this stuff.
And Simone, what have we been hearing from executives, from leaders of these businesses? How much concern have they been expressing?
Well, there's definitely the sense that consumers are softening, but they may not be cracking yet. There are still things they want to spend on, and a lot of those things are related to what they've experienced over the last couple of years. They've had to stay home over the course of the pandemic, and now they're continuing to spend on things like beauty, like apparel when they go out, but not necessarily on things like home improvement. There's a little bit more strength when we look abroad, but this is specifically on the U.S. consumer. And so they're pulling back on things like groceries, where they're turning to sort of the private label items. They are delaying some of their long-term home improvement projects. You know, one of the other things we've heard from a lot of executives has been about shrink and read theft in this. This seems to be an ongoing problem for a lot of, an increasing problem for a lot of these retailers. Again, the economy looking a little bit worse for the consumer, but we're not yet hitting this wall. We're not yet hitting this recession.
Simone Foxman, all about the consumer story. As we're getting mixed signals, we're going to keep her posted on those developments. Meanwhile, across the Atlantic, Turkey's central bank has extended its interest rate pause for a third month as it tries to keep the lira stable. This policy decision comes just ahead of the country's presidential runoff this weekend. Bloomberg's Yusuf Gamal Eldin standing by, joining us now. Yusuf, walk us through why this is important.
Well, this is not just about a repo rate that stays at 8.5% as expected. This is about a central bank doesn't want to appear like it's taking sides. It's about inflation at 44%. And that kind of raises the stakes for the runoff on Sunday. Remember, in the first round of the presidential election, we had the incumbent president Recep Tayyip Erdogan. He got 49.5% of the vote. You had his most credible threat, Kemal Kılıçdaroğlu. He came in second. And the third was Sinan Oğan, who has now endorsed the incumbent president. Erdogan, who's made quite a bit of a name for himself in terms of high borrowing costs that he's pushed down. He's ruled out rate hikes for the future. And that's the bigger issue, is what happens in the post-election world. And regardless of how this pans out, they're going to have to return to a relatively sustainable path of orthodox monetary policy, guys.
Yeah, wow, 40%, what, plus 40% inflation. We thought it was bad here in the UK. Talk to us about, is tourism a bright spot for Turkey? Is a weak lira proving attractive for tourists?
I mean, Tom, I was there, 10 days ago, and it was as busy as ever. They have this brand new airport. They do about 55 million passengers a year, and the latest numbers underscore the resilience of tourism in Turkey. I mean, we are up 29% on the year. That is in the month of April. You were up 12.3% in the month of March. As much as foreign currency inflows are still very much there, because the central bank has been intervening on a regular basis to try and prop up the Turkish lira, they have a net negative international position, which hasn't happened in 21 years. It gives all economists out there a lot to work with in terms of case studies and analyses, guys.
Yeah, indeed, probably for years to come. Yusuf Gamal Adin, thank you very much indeed for the preview, of course, and that runoff this weekend. Coming up, Christian Kopf, head of fixed income and FX at Union Investment, joins us. We'll get some calls there on how to position within these fixed income markets. And later, we're going to speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. Is the rally in tech overdone at this point? Plus, Tesla and Ford forming a rare partnership for their EV customers. More details on that still ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Look, it's all about the debt ceiling debate, and you're already seeing it getting very clearly priced into the markets. But what's the trade here? Do you hop into the bond market at a time when the full faith and credit of the United States is at risk? And in some ways, yes. And here's why. One of the reasonings or one of the cases to do that, it comes down to the real yield, because you're starting to see U.S. real yields actually rise. That was one of the big issues that essentially with kind of onset of inflation, yields weren't giving. And that's really where you start to see that reverse. You're seeing 248 on the 2-year TIPS yield, the highest going all the way back to the global financial crisis. That is a big deal when it comes to whether or not you want to hop into the bond market or the dollar. It's not necessarily about the U.S. anymore. It's about what gives the most with the least risk. So ironically, that is the dynamic at play. I want to bring in Christian Kopf, the head of fixed income and FX over at Union Investment. Christian, let's start there. Is that a fair trade to make? Let's say we do actually get closer and closer to this exit. In these next few days, what's the attractive trade?
Yes, Kriti, I think that this is a pivotal time we have right now. We've got, the debt ceiling discussion, which likely will come to some form of a conclusion today or at the latest over the weekend. And then we have inflation numbers coming up and the decision whether the Fed will do one more hike or another 1 or 2 more hikes. Now, when we look at what you mentioned here in the U.S. bond market, we see two things. At one hand, we see upward pressure here on the nominal yields, which come from a decline in risk aversion as the market is pricing out the risk of a sovereign default in the US. At the same time, we've got these relatively elevated real yields. On the 2-year sector, we've got a 2.4%. In the 10-year sector, we've got around 1.5, 1.6% real yields. These levels are already quite attractive. And I think very soon we will see a situation where people will start to receive those yields.
Christian, so that's the short-term play. Let's talk about the long-term play. The latest developments out of Washington essentially suggests a federal spending cap of about 2 years. That's good news when you're getting closer to those debt ceiling agreements. But Christian, in terms of growth, when you're seeing a lack of government spending directly affect GDP, are you at all concerned about the fact that that lack of catalyst from the U.S. government is going to hurt America's GDP? How do you view that?
Frankly, I'm not that concerned. I think that the spending caps, the caps on non-defense spending that will likely come out as an agreement today should not have a material impact on economic activity in the United States. There will be ways to circumvent those spending caps, and I don't think that the magnitudes we're talking about here should have a material impact on output. So I don't think that this is a reason to be concerned about economic activity in the US. You know, we are in a situation where the first quarter GDP growth was much stronger than expected, and overall employment growth is still relatively robust in the US. So if anything, it's probably a good time to take back some of that fiscal stimulus in the US. Yeah, so I don't think that's the reason really to go along here, the bond market. I think the reason to go along the bond market is the fact that we already have relatively high real yields, especially compared to other regions in the world. I mean, the numbers that you've shown here on the 2-year real yield in the US, and then you've got the 10-year real yield at around 1.6%, they compare quite favorably to other regions of the world. In Europe, the real yield on the 10-year sector is close to 0.
Hey, Christian, there's a scenario by the end of this, by the end of the next week, we have a deal on the debt ceiling. We get the PCE deflator out later today. The expectations are it's going to actually tick up from the previous month. We saw those jobless claims being revised lower yesterday, a reminder of the strength of the labour market, at least relative in the US. There's a scenario by the end of next week where June is going to be looking like it's locked in for the Fed. Would it be hyperbole to start, questioning whether or not this Fed may even be looking at 6% by the end of this year?
Well, you're coming back to the 6 is the new 5 discussion, no? That was a discussion we had in February this year. There was the U.S. Monetary Policy Forum in February in New York, and at the time, 6 is the new 5 was making the rounds. Now, I don't actually think we're going back to 6% or discussion, the 6% overnight rate here in the U.S. I could see a scenario where the Fed will hike in June. That is our long-held call. Some will depend on the inflation numbers we will get on the 13th of June. But overall, with the specter of sovereign default dissipating, relatively strong economic activity numbers, stubbornly high inflation, relatively strong labor market, our call is still that the Fed will continue to make at least one more hike in June. But I don't see the Fed going to 6% here, no. For that, the conditions are not in place. And keep in mind, we do have disinflation in the US now. It is actually stronger and faster, the disinflation, than in Europe. So I think that one more hike should probably do it for the Fed, and then they will start to wait for those disinflationary forces to play out.
Well, there you go. You point to the divergence between the US picture versus Europe. I know you've got your ear to the ground when it comes to policymakers at the ECB. 375 is where the benchmark is now for the European Central Bank. We had a reminder, though, of the weakness coming through from Germany and that economy earlier this week when it fell into recession, of course, for the first quarter. How far can the ECB push it, given the fragility that we're seeing in economies like Germany now?
Well, first of all, the shallow winter recession we have had in Germany, 2 quarters of negative GDP growth, were related to the very high energy costs. And we can now observe a fast decline in energy prices. You've got the TTF contract for the natural gas in Rotterdam trading below 30 euros on the megawatt hour. So we see a rapid decline in energy prices, and that is very helpful for the companies and also for the consumers. So that should help economic output, also actually helps the current account position of Europe. Second, we have relatively robust growth still in other countries of the euro area, especially in Italy, but also Spain. So Germany is not the only country out here. Third point has to do with interest rates. I think that it's fair to say that we already have a contractionary monetary policy in the US, a very tight monetary policy with an ex-ante real interest rate of around 1.5% to 2.5%, depending on the tenor that you choose. We don't have that in Europe. Our ex-ante real interest rate on the inflation-linked bonds is 0. So I think there the ECB still has a ways to go. And then also, I think that the wage dynamics in Europe, there is still a lot of catch-up growth to be done here in wages. People have seen a decline in their real income over the last year because of the very high levels of inflation. And we see wage settlements slowly creeping higher in the euro area. So there is a case to be made that the ECB should continue to hike. And that's actually what we believe.
Christian, in that scenario then, talk to us about how the interest rate differentials kind of come perhaps in conflict with some of the positioning around the debt ceiling that you're seeing in the dollar.
That is a very good point, Kriti. So we actually do have that conflict. I think right now, if the debt ceiling problem gets resolved, we could see euro-dollar move to 105 because, the risk aversion is getting priced out of the market. But actually, our call is still for euro-dollar to move higher by the end of this year. And that is driven by those differences, the divergence in the monetary policy. We do expect much more rate hikes, if you wish, from the ECB than from the Fed in the second or in the summer this year. So that should, over time, help to drive the euro higher. Now, there's a debate about how much the ECB will do. I'm just here in Dubrovnik, Croatia, attending the national conference, the annual conference of the National Bank of Croatia. We just had a presentation here by Philip Lane. The slides from his presentation are available on the ECB website. And he's pointing out to a lot of disinflationary forces which are at play in the euro area. But there are other people here in the room, people from the BIS, people from other central banks, who argue that actually inflation could be much stickier. That we may be moving away from that low inflation regime that we've had in Europe for 20 years or so. And that is a cause of concern for many central bankers in the European Central Bank Governing Council. So I think that, there is a debate really on how sticky inflation is and whether it will come down in the way that the ECB is forecasting.
Christian Kopf over at Union Investment, making time for us in this very busy day. We thank you, as always, for your time and for your insight. We want to keep you up to date with news from around the world. Here's the first word. Bloomberg has learned that UBS and the Swiss government haven't agreed to the precise terms of state guarantees for the emergency takeover of Credit Suisse. Sources say the deal's completion could be pushed back to June instead of late May. UBS and the government are also still haggling over the regulatory implications of the takeover, including capital requirements and liquidity rules. Siemens Energy says it's experiencing a surge in demand for green transition technologies as governments around the world move away from fossil fuels. Speaking at the Bloomberg New Voices event in Frankfurt, CFO Maria Ferraro says after years of supply chain holdups, the company now has an overflowing order book.
When it comes to certain parts of my business, I'm booking orders now for 2028, 2029, and 30, because we see that this is a long-term plan. We need to think about the transition, and it's not something that causes a knee-jerk reaction on conditions today.
Alibaba says it plans to hire 15,000 people this year, pushing back on reports that the firm is laying off employees. The Chinese e-commerce giant described reports of layoffs as, quote, rumors, and said employee departures are part of the normal flow of the business. Tom, your take on this Alibaba story at a time when it feels like a lot of the world is dealing with an extremely tight labor market.
Yeah, indeed. And of course, this is a sector that's been under pressure as a result of the regulatory squeeze, and officials have come out and said, do you know what, we're going to support the tech sector now. But there's a political angle to this as well, which is that companies like Alibaba, they don't want to be seen to be laying off huge numbers of workers. It doesn't play well with, of course, their patrons, particularly at the state level or the provincial level. So there's that part of it as well. But the interesting story at the corporate level is they're looking to spin off about 6 of their divisions, the logistics part, but also the cloud division as well. So a major restructuring underway overall for Alibaba.
And how does that square then with some of the, perhaps the regulatory kind of deal when it comes to Alibaba? When I think Alibaba, I immediately think all the controversy around Jack Ma. Where are we on that?
Yeah, Jack Ma has kind of been revived to an extent. He's still keeping his head down, but we've seen him appear now in mainland China. So he seems to be on surer footing. And they've got the blessing, it seems, to do these spin-offs. In fact, they're being encouraged to do so because there's always been this concern amongst regulators about the oversized power and play of some of these tech companies. So they seem to be getting the back of that. And again, investors, Anna, say, look, you can unlock a lot of value here. Again, on the jobs front, the context is there's about 20% unemployment amongst China's youth. So there is that as well to bear in mind. It's pretty scorching in terms of the unemployment pressures there, and they don't want to be playing into that.
Yeah, it's pretty fascinating. I love to look at the Alibaba story because even though we kind of group it in the tech story, Bradley and Tom, of course, you're an expert here in this. The idea that at some point they actually did want to build out that financial arm is fascinating. Yeah. It's kind of the American equivalent of if, say, Apple wanted to build out a bank, for example. I'm sure that's a little bit of a stretch, but that's the way I think about it.
I don't think that's a good analogy, and I think we definitely need to keep an eye on what happens with Ant Financial and whether they revive those IPO plans, because that is definitely one to watch. Now, coming up, we're going to speak to Jay Woods, Chief Global Strategist at Freedom Capital Markets. We'll keep an eye and the finger on the pulse on tech, get his views on this AI-fueled rally that we've seen. Nvidia, does it have further to run? Jay Woods coming up. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Hurtling ahead, Republican and White House negotiators are making progress toward a debt ceiling deal, which is set to include capping federal spending for 2 years. Tech shares remain in focus amid the frenzy for AI stocks, but investor Cathie Wood is missing out. Her flagship ARK fund dumped its stake in Nvidia right before the chipmaker's $560 billion surge this year. And I'm Kriti Gupta in New York with Tom McKenzie, stepping in for Anna Edwards in London. Tom, a lot going on the macro front, a lot going on on the micro front as well, but the debt ceiling still the focus all around the world.
Yeah, and some of that temporary relief that came through in the European session has come off now. So you're flat across the European benchmark as investors kind of look for the next catalyst and wait on that deal to come through, if indeed it does materialise. Euro dollar currently gaining 0.1%. Of course, the Bloomberg Dollar Index is off in the session. A couple of individual corporates to bring to your attention. Rio Tinto has been upgraded by Morgan Stanley. It says that its holdings of copper are being undervalued by investors, and that stock is gaining on the back of that upgrade from Morgan Stanley, 3.5%. It ties in, of course, to the shift and the repositioning around electric vehicles. And in the supermarket space in Europe, particularly in France, Casino is embroiled now in discussions with some of its debtors. It's going to have to sell off a number of its supermarkets. That stock, after being suspended on Monday, retrading again today, taking a hit down 7.8%. Kriti.
Yeah, seeing a little bit of pain on the micro front there. Let's go back to the macro, zoom out a little bit, Tom, because stateside futures virtually unchanged. I mean, you're seeing down about 0.2%, so a little bit of sentiment souring, but this makes sense. It's a Friday. There's a long weekend coming up stateside, not to mention the X date getting closer and closer. So to see that to the downside, not that much of a surprise. Does it turn around, though, as we get developments perhaps before the long weekend, which I'm told Congress is not working? The 2-year yield is something to keep an eye on as well, because, again, as sentiment sours, a bid into the bond market, 448 on the front end of the curve, lower by about 4 basis points, and with it taking down the dollar. And that's going to be a really interesting story as, again, we talk about simply what is driving the dollar story, given there's so much speculative positioning in the greenback, despite the debt ceiling concerns. Of course, NYMEX crude, the ripple effect of the dollar largely showing up there. That's where you're seeing a little bit of sentiment change. Still trading with the 72 handle, Tom, but a little bit stronger since what we checked in about 30 minutes ago.
OK, let's get back to what was at least a key driver for these markets yesterday, and probably will continue to be so in the weeks and months ahead, which is, of course, AI, and particularly the focus yesterday on Nvidia. Let's bring in Jay Woods, Chief Global Strategist at Freedom Capital Markets, to talk all things markets as well. But let's start with tech, Jay. Good morning.
Hey,
Thanks for joining us. And the story that we have is very well read on the Bloomberg around ARK, of course, Cathy Fund and the main fund selling out of Nvidia earlier this year, so not benefiting from the upside that we've seen in the last couple of days, the last few weeks for that stock. How much of a critique is that of the ARK strategy?
Yeah, you know, I'm not here to be critical of the strategy. I mean, last year they sold out of Twitter, and that would have been the biggest winner in the fund as well. It's struggled lately. It was down 81% peak to trough, but I'm seeing some progress there. You want to look under the hood. Some of the stocks within the sector have been acting much better. You look at Exact Sciences, DraftKings, we're seeing, and Shopify, those are 3 that are starting to turn. And then it's been basing. You've seen the stock go sideways, up 30% year to date, and it's recaptured that 200-day moving average. It tricked us once. It did that before, but let's watch this level closely, because I think if the small caps start to turn, if AI becomes more of a story and tech follows it from there, she's got some good product in the fund, and we could see it take a nice leg higher. Is it going to be euphoric like it was the last time it ran up? No, but there is a lot to reverse here, so there's progress being made.
Jay, does this AI story have further to run? How do you want to play this? We were speaking to guests earlier on Bloomberg TV saying, look, there's a risk that you get sucked into some of the frothier, some of the boomier stuff, not looking at the industrial play around AI. Is that the way to position?
Yeah, I mean, Nvidia had a day of all days, and that guidance was something I've never seen in my experience here. That was just phenomenal. So I think there is more room to run. The semiconductors have been strong all year. There's a lot of strength. There's semiconductor stocks breaking out of large bases, Micron being one of them. So I think this is a story that's here for a while. There is a euphoric sense to it that gets me a little concerned that we go out too far above our skis and we could see some pullbacks. But this is a story that's not going to go away anytime soon.
So, Jay, that is the defensive kind of trade, almost the beta play of it, which, by the way, we should say that one of the tailwinds is also coming from the debt ceiling story, the macro story. If you're worried about a recession around the corner, you go defensive, right? That's something we've been hearing from a lot of guests on Bloomberg Television and radio. But then there's the other side of it. If you're worried about recession, you're worried about small caps. Are you?
Yeah, I mean, small caps have been the laggard all year. And we look at the Russell 2000, and what are we seeing? We're seeing, you know, sideways action, but we're seeing higher lows. It's at a very critical level right now, testing its moving averages, testing its recent uptrend line going back a few months. Like the market, it's kind of stuck in that position where we're going to break one way or another. If we can get a break to the upside in the Russell, and historically, this is a seasonal period where we see some strength as we go into the Russell reconstitution, which will be later in June. We tend to see a little bit of a rally. So I'm hopeful, and hopeful is the key word, that this trend continues, and the small caps, if the regional bank crisis can abate a little bit more, can bounce back and and be a strong contributor in the second half of the year.
Well, it's an interesting dynamic that you're seeing in the Russell. And before we move forward, I want to tell our international audience specifically that you've been on the floor of the New York Stock Exchange for, what,
31 years.
31 years. So you have seen the highs and the lows. Talk to us a little bit about the breadth here of the market. One of the big concerns is simply this is a tech-heavy market. To me, it feels like you need both the Russell and the NASDAQ on your side for this to be sustainable.
You do, and it's one thing that we talk about that's a little concerning right now. The breadth has not been there. It's 10 stocks leading us up, but it's the right leadership. When you're looking for things to turn, you want tech to lead. Now I want to see the financials find their legs. It looks like that May 4th, May 5th washout that we saw in the regionals and some of the larger banks may be the lows. If that is the case, the Russell will slowly come back and we'll see a broadening of the breadth. That is the one thing that has me concerned. But right now, consistent higher lows with a base or a resistance level at 4,200 in the S&P 500. We may break above. And then the Russell here, the 200-day moving average. There's some constructive things happening under the surface. I'd just like to see it broaden out a little bit more.
Hey, Jay, look, we know the connection between higher yields and financials and the prospects for the banking sector. Higher yields and tech, that's not meant to go together. Is this temporary, that we've seen these yields run up and yet NASDAQ has continued to perform well? Is this a new trend or is this a temporary evolution?
You know, I think COVID has changed the way we look at everything. I have no idea why, it's not the textbook way of doing things. The tech stock should be getting crushed given the rise in rates. But no, they're not. What people are doing is they're separating. It's not all tech. It's select tech. They're finding the winners, the best in brands. You're seeing it across all sectors where, the leadership is doing well, but that doesn't mean the tide is lifting all boats. We're seeing, very selective trading. And Nvidia was just, you look at the SMH, Nvidia is far and above everything else in that sector, and it's starting to lift all boats. If rates continue to go, if we go 6%, I think that will have a direct impact on the tech sector, and we should see, at worst, a pause. At best, a pause, and at worst, a little bit of a sell-off.
You've set me up really nicely, Jay, talking about tide lifting all boats. To cruise lines, this is in your notes to us. This could be a sector that's turning, you say.
Yeah, it was a nice segue. I've been watching the charts of Carnival Cruise Line, Norwegian Cruise Line. I talked about COVID being something that disrupted everything, and we'll look back and we may have an asterisk on how we looked at the economic effects on things. Well, the cruise lines got hit, and like a cruise ship, it takes a long time for these things to turn around. And what I'm seeing are constructed bases, higher lows, and now breaks above some key levels. In Carnival, watch that $12 level. Norwegian, their numbers have been fantastic, and if you look at their numbers before 2019, they're up. They're up 30% from 2019 pre-COVID. So price hasn't followed yet. They have a long way to go, but I'm seeing progress, and the sailing ahead may be smooth, to continue on that pun.
All right, Jay, a final question here as we get prepared for this long weekend, the debt ceiling, X date, et cetera. You think it's going to work out?
Oh, do I think it's going to work out? Yes, I think it's going to work out. Do I hope it happens before we go away on this weekend? Most definitely. That's the one thing traders don't like, is to, have to be checking their phones, checking the news over the weekend. Coming in on a Tuesday light volume could cause a lot of volatility if nothing's settled by the weekend. Hopefully they can get it done by then.
Okay, watch this space. Jay Woods, excellent. Thank you very much indeed, of Freedom Capital Markets, on this tech sector, on the debt ceiling, of course, on the prospects for these financials. Thank you. Coming up, JP Morgan telling 1,000 First Republic employees they won't have jobs as the takeover unfolds. More on that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Brett Keller, the CEO of Priceline. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Now we head to Wall Street, where JP Morgan notified about 1,000 First Republic Bank employees that they aren't being given jobs following its takeover of the failed lender. Joining us now to bring us all the developments, Bloomberg Wall Street correspondent Sonali Basak, waking up early for us and joining us on set. We kind of knew this was coming, right? This happens when there's mergers.
Certainly, when there's mergers, not everyone can come on board, especially with two banks like JP Morgan and First Republic, where there is overlap in terms of jobs. I would also remind you that JP Morgan is one of the banks that really expanded headcount pretty meaningfully in recent years, including in the tough times of the last year or so, where we've seen a lot of banks cut jobs. We know that JP Morgan's headcount has actually expanded over that time frame. Now, remember that this is about 85% of First Republic's job force here that were given either full-time or part-time jobs. One question I have, Kriti, is how many of those part-time jobs become full-time jobs, or do they start to taper off over time? I guess it really depends on what kind of business is brought in from First Republic as the integration ensues.
Yeah, and it's worth saying that JP Morgan spokesperson has said, look, it's a stressful time for them all, but at the end of the day, they are updating the employees on their status within 30 days. So worth bringing that clarity from the bank itself. Let's go to another bank here. Morgan Stanley seeing some job cuts, not stateside, but in Asia. Walk us through it.
Yeah, remember, Morgan Stanley had been undergoing a kind of more global headcount reduction to some degree here. We know they made a small one at the end of last year, then they had an additional one this year. The market has been really soft, particularly in Asia, where deals has not really started to come back. Remember, Morgan Stanley's headcount there was already larger than a lot of global peers. They have a large investment banking workforce there. But what is striking about our report here, Kriti, is that some of these job cuts even extend to people who were promoted in recent years. So that shows you kind of the extent of the pain that the market is feeling, and the unwillingness of certain banks to keep staff on at scale, or at least the scale that used to be, as they look towards what the next cycle starts to look like as deals may start to come back.
And Sonali, meanwhile, in this part of the world, there's some Bloomberg reporting suggesting that maybe finalising the deal, the takeover, UBS, of course, Credit Suisse, that's going to take a little bit longer because they're having a wrangle with the Swiss government, UBS are, about this backstop.
Yeah, and that is an interesting story, especially on the talent perspective, Tom. We're talking here a lot about this top story here of UBS offering really incentives for wealth managers here, particularly in Asia. You're talking about your part of the world. Remember, there's still a humongous concentration of wealth when you look at China and the broader Asia region here. And the incentive is quite rich, if you will. It's about 15 basis points for every $100 in new client money that can be brought in. Remember that it's not usually so specific or even so large when you look at wealth managers, but it just shows you as the deal uncertainty continues on, you have UBS's top brass going to Asia and making sure that they can keep people on in this really uncertain time frame.
Bloomberg, Sonali Basak, all over the global Wall Street story. We thank you as always. Another story that we are monitoring very closely comes in the car maker space. Ford has struck a deal with rival Tesla to give its electric vehicle customers access to the Tesla supercharger network. Tesla CEO Elon Musk discussed the benefits of the deal in a Twitter Spaces session with Ford CEO Jim Farley.
I think it will not be cost prohibitive. It'll be, something that's quite affordable. In the hundreds of dollars range, it's an adapter, so it's not super expensive.
Look, Tom, this is such a fascinating story because at the end of the day, when you look at Tesla and Ford kind of combining, they are, at the end of the day, rivals. Ford trying to catch up with Tesla in terms of their EV scaling. So this one kind of caught me by surprise.
Yeah, it certainly seems like it's good news for consumers, right? Good news for drivers, because they do have that infrastructure. And this has been part of the shift, the spending, of course, within companies like Ford as they play that catch up. But they've also needed that infrastructure. I don't know about the US, but certainly here in Europe and the UK, it does still dominate. And there is that catch up amongst many of Tesla's rivals.
Yeah, you're already seeing that getting boosted a little bit. Tesla shares higher by 0.5%. Ford, I believe, also moving on that story. So certainly some stocks we're going to be watching there. A few more I want to put on your radar, though, especially in the chip maker space. Look, we're a day out after that blockbuster move from Nvidia shares. And you can see it is still kind of up there. 380 around is where the stock is trading, down about 0.2% in the pre-market at the moment. But look, some of its rivals, Intel, for example, which took a little bit of a hit yesterday, higher this morning, trading higher by about 0.4%. Advanced Micro Devices in that same boat, higher by about 1.2%. But the AI theme continues throughout the tech space, specifically with Marvel Technologies. And this is, for the record, not the company that makes those superhero movies, Tom. This is Marvel Technology, the ticker MRVL there, trading at about $57 a share, kind of doing the same thing that Nvidia did. They are seeing that their 2024 AI revenue is going to double, pushing those shares higher by 16% in the pre-market. So that's your chip stories there. We're going to be monitoring that throughout the day. And of course, Gap could talk about the other side of the spectrum, the perhaps more cyclical consumer nature of the spectrum. Gap shares rising as well. Essentially the hit that we expected them to take, not that bad. In fact, they're recovering faster than expected. Those shares, GPS is the ticker, higher by about 12.5% in the pre-market, Tom.
Kriti, I'm glad you offered that clarity because I wasn't quite sure. Yeah, Marvel the comics or Marvel the tech and AI, and it's the important. AI one that we're focused on. It is important. Thank you. Right, coming up, US Treasury cash balance shrinking to below $50 billion. More on that next. This is Bloomberg.
While inflation is still too high, there are some promising signs of moderation. And I believe that we may be at or near the point where monetary policy can pause raising interest rates. And this will provide an opportunity to more fully assess the impact of the actions we've taken to date.
That was Boston Fed President Susan Collins speaking yesterday in Rhode Island. Joining us now is Bloomberg International Economics and Policy Correspondent Michael McKee. Look, the default worries intensifying, the Treasury's cash balance dropping to its lowest level since 2021. What are your takeaways here? Why do we care?
Well, the interesting thing about the Treasury cash balance, as our colleague Kayleigh Lyons pointed out, 24 people on the Bloomberg rich list have more money than the Treasury Department right now. So they are very short on cash, and it does mean that they're going to have to, by June 1st, either temporarily punt it down the road or raise the caps by the debt ceiling by then. They've got $101 billion in various payments, including some Social Security and Medicare due on June 1st, and they got 49. So the math doesn't work. Yeah. But the question is, do they at this point feel a sense of urgency? The old saying, nothing concentrates the mind like a hanging, might come into play here.
Can we just point out that you're wearing dollar cufflinks? How appropriate for the debt ceiling debate?
Yeah, try to keep up.
with the Treasury. Mike, talk to us a little bit about kind of what happens after this deal if it is passed. What happens when it's passed? What kind of effect does this have on the actual economy?
Well, that's an interesting question that hasn't been really focused on because we've all been worried about what happens if they hit the debt ceiling and go over it. It looks like maybe they're not going to, so then what does this budget deal mean? Well, we don't have all the details, but basically it doesn't mean a whole lot to the economy because they're only talking about non-defense discretionary spending, and not all of that is included. They're still going to be spending money on veterans programs. Defense spending is going to go up. The entitlement programs are still going to go up as they automatically do. So it's going to have a very marginal effect, if any, on growth. And you always have to ask in these situations, growth compared to what? The baseline from the budget that was passed last year, they're not going to go down all that much, and it's going to be over a period of 2 years. So you really don't expect much to happen to the economy because of this.
Mike, does a deal, if it comes to pass, does it clear the way? Does it clear the path for a June hike from the Fed?
You could argue that both ways, Tom. The feeling had been that if they hit the debt ceiling and went over it and we were in a default kind of situation, that no, the Fed could not raise. But if they do pass it, then the question becomes what happens with inflation? And it's, of course, a good question to bring up today because we get the PCE inflation numbers coming up in just a couple of hours. And despite what Susan Collins said in that sound just before I came on here, we are not seeing any progress anymore. We we had seen progress, a lot of it, in bringing down inflation. But if you look at the forecasts, we're not going to see much, especially in terms of the PCE core. It's not moving down. It's kind of stuck, sticky inflation there. So the question is going to be open for a while, up until the 14th of June when they meet again, as to whether they raise or not. Something to keep an eye on.
And Mike, more broadly across this US economy, the resilience of the labour market, we saw that again with the revisions around the jobs claims yesterday. Are other areas looking more vulnerable even as the labour market holds up?
We haven't seen a huge amount of vulnerability. We are getting to the point where companies are hiring fewer people. We don't know whether that's because they're preparing for recession or because they've finally found the workers that they needed. Because each month we're still adding more jobs than we need to account for new workers in the labor force. So at this point, we're going to be very interested in what happens next Friday to see if we do see a decline in hiring towards that level, or if we see any kind of increase in unemployment that suggests that maybe the labor market is loosening up and companies are preparing for worse times.
And of course, the economic data coming in at 8:30 a.m. today. Mike McKee will be all over the PCE numbers and the personal spending numbers. Bloomberg's Mike McKee, international economics and policy correspondent. We thank you as always. Folks, that is it for early edition. Markets a little bit sanguine today. Let's see if that changes when we get closer and closer to the opening bells. Right now, surveillance, though, is going to take you throughout at least what to prepare for, what to listen for over the weekend. Crossmark's Bob Dole, Morgan Stanley's Mike Wilson, and Megan Green of the Kroll Institute all joined the program, as well as I hear a guest from Formula One. Interviews you do not want to miss. Stick with us. More surveillance ahead. This is Bloomberg.